All right, folks, welcome back. This is the 7th episode for the ICT Mentorship on YouTube 2022. This lecture is going to be dealing with daily bias and consolidation hurdles. All right, folks, looking at the daily chart for the NASDAQ. If you're looking at trading view under the NASDAQ selection, so it's the continuous contract. That way it makes all the candles look nice and crisp and you don't see any spotting. So right away, if you're looking at this, you should see this run on price, taking out buy side liquidity. See all these relative equal highs here? Ran above it, then broke below a swing low, created what? Fair value gap. Trades up into it. Now where's it going to trade to? This low to this high, midpoint. There's a gap right there. And then you have the old low. Sell here, aim here, or here. And it runs it out. Now, this is important. Obviously, it sounds like, well, you're cherry picking in the pack old moves. Okay, that's how you learn. But think about what's happened on the daily chart. We traded below this low. We've taken sell-side liquidity out of the marketplace. So with that, it's likely to retrace back up into the range. What's the range? This high to that low. But look closer. See how we have this nice energetic run? Look how many down closed candles we have here. 1, 2, 3, 4. A lot of movement there. So I'm looking at this high and this low. And I'm trying to get a range for where we are at present. So once the sell side was taken out here, it's likely to retrace back inside the range of this high and this low. We've seen it come all the way back up. It went to a premium market, which is above equilibrium here. And then we went down below to a discount, bounced off of the old low here. Then we've consolidated around equilibrium. Now, when you have this condition, it can make it very difficult to get a true reading on bias. Okay, so there's times when even me as ICT, I don't have a good, clear read on what it is I'm looking for. So I have to demand more price action and more information, or intel as I like to call it, based on what the market's going to do right after the open at 9:30 in the morning, New York time. So if we have this set up on a daily chart, market structure has a shift lower, we trade up into a fair value gap. Until we get down to here and here, each day I'm anticipating lower prices. So my bias is bearish. Now, every single day is going to be a down closed candle, but I'm going to hunt intraday price action with that in mind. If I'm going to take a long, it would be counter trend to that bias. My leverage is going to be dialed back. So from this high down to that low, each day I'm going in with the expectation that it's going to likely set up a sell scenario where I can get short and hopefully buy back at a lower price. Count how many up days or green candles there are from this high and this high down to that low. So the delivery by the algorithms are spooling. That means prices expanding and going directionally one way. When that occurs, there's going to be times where you have an up closed candle. That may be a day that you tried to go short and maybe you've lost. Okay, no big deal. Same thing going into the next day, going in for looking for shorts. Next day, same thing. Same thing. And then here, it opens and trades down below the low and has a huge expansion move and then comes back above and that's it. It closes on the near the high today or midpoint of the body in this area here. Is there a lot of up close candles during that bias being bearish? No. So you're going to utilize the daily chart to determine whether or not the next candle is going to be likely bullish or bearish. Between this high here, in the midpoint of this low to high, I'm expecting down close candles. That would equate to a bearish bias. It doesn't mean that I can't take a long entry. It just means that if I do take a long entry intraday, I'm going to do it with far less leverage. And if I see a setup that's bearish, I'll use or consider using, not always, but I'll consider using my maximum risk, which is 4.5%. Until we get down to this low and underneath it, that means it's likely to reverse or consolidate. And we have a retracement back in. So once it starts doing this and it's hanging around equilibrium, it gets very difficult, even for me, to determine a bias. So what does that mean? No trading? No. It just means that you have to rely on the smaller time frame intraday charts and just simply look for liquidity pools. So you're going to trade intraday volatility, running old highs, running out old lows, being a lot more nimble and like a surgical strike. You take your handles or your points that you're trying to get out of the marketplace and then run. You don't try to overstay your welcome. So let's go down to a lower time frame. All right, so we have the 15-minute time frame and we have our 8:30 in the morning crosshairs here. Crosshairs are the vertical line that denotes the time that we start looking back to the left. Okay, right here, go to the left, we see here, this is our first low. So we mark that. And right in here, first to the left is here. We don't want to use this low by itself because it's inside of this candle. So I want to use the extreme. Where's the liquidity going to be? Is it going to be above this? Or is it going to be above that? It's going to be above this. Okay. Why? Why not that one? And why this one? Keep looking left. What do you see over here? See that? These are relative equal highs. What does retail traders see that as? Resistance. So they see it going up to here, stopping and going lower. They see it going up to here, failing to go up here. So now they think this is a really strong resistance level. And it went lower. Look at that. Then the market showed how that level was real resistance by going right through it. But this would be a first target here to reach for. And if you want to use a longer term intraday, target would be back here. Obviously, with the benefit of hindsight, you can see that we traded below that low here. Then we reversed and started going higher. We took out this high here. Now on the 2-minute chart, why the 2-minute chart? Well, that's for your homework. You go through the 5-minute, the 4-minute, the 3-minute, the 2-minute, and the 1-minute chart. I'm going to utilize the 2-minute chart because this is what I was using today for my own analysis, okay? All right, so you can see how we had the old low here. We trade down below it, and this 1004, I'm actually highlighting that candle right there. The reason why I'm using that candle's low and taking the screen capture there is I want you to see the low candle's price. Okay, so that's where your stop would have to be just below that, maybe one tick. By going long in here, based on the logic I'm going to start to outline here. The market trades below the old low, trades below it, rallies above, but does it trade above this short-term high yet? No. Then it goes down once more, below the old low, but not below this low here. Then it turns and goes higher. What did I see in this chart that allowed me to go long in here? Nothing. I didn't see anything in this particular chart. I saw it in the S&P. S&P, similar situation here. High, that's the best case scenario for the day. This high here, that's where it could reach for. 830. We're right here. What's the point of expecting it to go above that? Not much. We want to see some kind of a protraction. So the market, yes, it went above that short-term high and then went lower than that low. Yes. But watch what happens. It trades below it, comes back up, and look at all the volatility and the sloppiness inside this area here. Then the market starts to rally. So the draw on liquidity is going to be here. It took out sell side here. So let's look inside this price action and see if there's any details that would lead to a run into that, we'll call it the 44.95 level. Okay. So the 2-minute chart, the market trades below the old low, as we see here. This low candle, it's high. Then we have one candle up. The next candle's low. There's your fair value gap. That's the run in here. So we have displacement low and displacement high. Is there a market structure shift bullish? Yes. It trades up above it. And then you look for the fair value gap. Is there one in here? No. Anything in here? No. How about here? No, it's closed in. It does not move down here. But we have this. So we trade down into it here. At 1036, that candle forms. That's a long in S&P. Now, compare that with this fair value gap in the S&P. We traded below the old low. We took sell side out. We have a shift in market structure on the S&P. These averages tend to move in tandem. So that means they generally move in the same direction. So I'm looking at the Dow, even though you don't see me trading it, I'm looking at it. I'm also looking at the S&P, even though I'm favoring the NASDAQ because its volatility and its movement is more than the S&P. Other traders might be fearful of the volatility and say, oh, I don't want to trade that. It's too fast for me. I am loving this because I know how to trade. I can work within that volatility because I know what I'm looking for. I know the signatures the algorithm is going to put out. So until I get these signatures, I have to wait or put leaders into the marketplace, which is what I'm going to show you when I show you my live account results today. But at 1036, let's go back up to the NASDAQ. We don't see any fair value gap in there, do we? Nope. But we start to see NASDAQ turning. So I went in long in close proximity to this order block. Okay, I went in at 14,505. That's inside of this order block. So I'm trading close to it. So if we're expecting a fair value gap to be a launching point for the S&P, and these markets generally move in tandem, I don't need the fair value gap in the NASDAQ because I'm utilizing the S&P as my indicator. So the logic is that S&P low in here was trading down into an old fair value gap over here in its price swing, but there is no fair value gap in the NASDAQ. See that? Now let's go back down into the S&P. Fair value gap, trade down into it there. That's a long for S&P, but I don't want to trade the S&P. So I'm going to use the timing of that candle for my long entry on NASDAQ, trading what's not in the chart. So market rallies and it trades into that short-term high that was seen on, let's go back up right here. So again, just roughing it around that 44.96, 44.90. We'll just call it 96, 44.96. And that would be right in here. Bang. Hits it, sweeps it, accumulates some more, and then rallies even higher, taking out that longer term old high. What gave me the confidence that this was turning here? Well, let's take a look at the three averages together. If you look at how the market's trading low here on the Dow, this top chart is the Dow futures. The NASDAQ futures is in the middle, and the S&P is at the lower end here. So it's Dow, NASDAQ, S&P. During that decline in the NASDAQ and the S&P, look what the Dow's doing. It's saying, nah, I'm going to sit this one out, boys. It's not willing to make that lower low. Where NASDAQ did, S&P did. When you see that right there, and here's an important thing, you anticipated already. You're not looking for this. This is what some of my students, when they come into my mentorship, they see this pattern, they think, oh, it's diverging, so that means it's going to go the other direction. No. This is something that confirms an idea that you had already established before price does what it's doing real time. What does that mean? You're already looking for a reason to go higher. So that means you're looking at an old low. Does it trade below the old low? Okay. Does it have a shift in market structure that's bullish? Yes, we saw that in the S&P, but we did not see it in NASDAQ. No evidence whatsoever was in NASDAQ this morning with what I'm teaching you. But it was, listen, it was in the S&P. And no, I don't trade the Dow, but I utilize it like an indicator. It's not plastered all over my chart. I'm referring to it because I have multiple monitors. I'm looking at my screens. I have a screen that shows charts like this. So I'm looking at the relationship of all three averages stacked over top of one another. And if I'm looking at a period of time and an area in price action that maybe is going under accumulation for long positions, this is what I'm looking for. I'm looking for that little fingerprint of the algorithm. What this is indicating is the Dow's unwilling to go lower than that low. That tips off individuals that are looking for cracks in correlation. Okay, correlation would be they're moving lower here, here, and here. But that correlation where they move in tandem together cracks here at a very important time, right when the NASDAQ and the S&P are trading below its old low. I get questioned all the time, ICT, how do you know it's going to be a fake break below an old low and rally higher, or a fake break above an old high and go lower? But nonetheless, I want you to think about how this pattern confirms the accumulation of long positions. The Dow is not going down because buyers are coming in. That's not what's happening here. This is an unwillingness to deliver to that low. This is a macro. A macro is something inside of an algorithm that prevents or enables delivery. Delivery of what? Price. So the Dow is unwilling to go lower here. Okay, by itself means nothing. Does it happen at the same time that the NASDAQ went lower? Yes. At the same time the S&P went lower than that low? Yes. Okay, so let's go back. Here's that old low prior to 8:30. Remember, algorithms run on time and price, not price and time. The low, that's the price, yeah, but you have to refer to time first. What's the important factor of time? 8:30, go to the left. What's the first low? Right there, boom. So there's liquidity below that. It trades below it here. Then wait. Do we get a signal that allows us to hunt what I'm teaching on this mentorship? There's the swing high. It breaks it there. So now market structure is shifted bullish. Look back through this price leg. There's your fair value gap. Oh, but what happens if it goes down there and it keeps on going? That's what your stop is for.